Hey everyone, welcome back to Trek for Wealth, the podcast where we talk about money the way real people actually talk about money. I'm Avery.
And I'm Grant. And Avery, this week's episode is one of the most personal ones we've done yet.
It really is because it touches something that millions of Americans are either actively dealing with right now or just hoping will magically get better.
Mortgage rates.
Mortgage rates. And more specifically, why they are so stubbornly, frustratingly refusing to come down.
We've been getting this question a lot. The Fed has been cutting rates, so why is my mortgage rate still over 6%?
And the honest answer is most people fundamentally misunderstand how the Fed and mortgage rates actually connect. And once you get it, it all makes sense, even if it doesn't make you feel any better.
That's Trek for Wealth for you. We'll give you the truth, not the comfort.
Let's get into it. Okay, Grant, let's start with where we actually are right now, because the numbers are genuinely confusing if you've been following the headlines.
Right, so here's the situation. The Federal Reserve cut interest rates 3 times in 2025. By December, the federal funds rate had come down by a full 1.75 percentage points from its peak.
Okay, so significant cuts, real cuts.
Real cuts, yes. And yet, the 30-year fixed mortgage rate right now is sitting right around 6%. Freddie Mac reported at exactly 6% just this week.
Which is barely lower than it was a year ago.
Barely lower. And most forecasters, Wells Fargo, Bankrate, the whole analyst community, are projecting it stays in that 6% range through all of 2026 and into 2027.
So the Fed cuts rates by almost 2 full percentage points and mortgage rates barely budge? How is that even possible?
So this is the core thing I want every single listener to fix in their head today. The Fed does not control your mortgage rate.
Wait, say that again?
The Federal Reserve does not set your mortgage rate.
Okay, that is going to surprise a lot of people.
It surprises almost everyone, and it's so important. So what does control your mortgage rate is the 10-year Treasury yield. That's the real benchmark. The Fed controls short-term overnight rates, basically what banks charge each other to borrow money overnight. That is a completely different animal.
So walk me through why that matters for someone sitting at home wondering if they should buy a house.
So when a bank lends you money for 30 years, they're making a bet that spans 3 decades. They need to price in inflation over 30 years, economic risk over 30 years, the chance you might not pay them back. So they look at what investors demand to lend money to the U.S. government for 10 years, the 10-year Treasury yield, as their benchmark. And right now, that yield is sitting above 4% and showing no signs of dropping dramatically.
So even while the Fed was cutting short-term rates, the bond market was essentially saying, we don't believe inflation is truly beaten yet. And mortgage rates followed the bond market, not the Fed.
Exactly. And this is why, counterintuitively, mortgage rates actually rose in early 2025 as the Fed was cutting rates.
Wait, mortgage rates went up while the Fed was cutting rates?
They did. The Fed cut rates in late 2024, mortgage rates went up because bond market investors were pricing in persistent inflation and uncertainty. The Fed's cuts were essentially irrelevant to your monthly mortgage payment.
That is wild and something almost nobody explains to homebuyers.
Almost nobody. Chief economist Ali Wolf put it simply. She said mortgage rates went down before the Fed cut rates and went up after. Same tuts, opposite direction. The market moved ahead of the Fed and then recalibrated when inflation data didn't cooperate.
Okay, so let me make sure I've got this. You want to know where mortgage rates are going? Don't watch the Fed, watch the 10-year Treasury.
Watch the 10-year Treasury. That's it.
Okay, now I want to go to the history, because Grant, there is a man at the center of this story, someone who faced a Fed crisis that makes today's situation look gentle.
Paul Volcker, chairman of the Federal Reserve from 1979 to 1987. And in my view, one of the most consequential economic figures in all of American history.
Set the scene. What was the economy like when Volcker took over?
Okay, imagine everything that's happening today. Inflation above target, oil price shocks, economic uncertainty, and multiply it by 5. When Volcker was appointed by President Carter in August 1979, inflation was running at 9% annually, and it was climbing.
9%.
By March 1980, it hit 14.8%. The country was in a genuine economic spiral. People were wondering if American capitalism was going to survive it.
So what did Volcker do?
He did something so radical, so aggressive, that people literally protested outside the Federal Reserve building. Farmers drove their tractors to Washington in protest. Home builders sent him pieces of lumber with angry notes attached.
Wait, they sent him lumber?
Lumber with notes because nobody could afford to build homes anymore. He raised the federal funds rate to levels nobody had ever seen. It peaked at 20% in June 1981.
20%. For context, today we're talking about rates between 3.5% and 4%, and everyone acts like it's a catastrophe.
Right. And here's where it hits home. When the federal funds rate hit 20%, the entire cost of money in the economy skyrocketed. The average 30-year fixed mortgage rate in 1981 was 18.45%.
18%. Let that land for a second.
The average home cost about $82,000 in 1981. With an 18% mortgage after a 20% down payment, your monthly payment was over $1,000 a month, which in today's inflation-adjusted terms is equivalent to about $2,500 a month.
Just principal and interest, nothing else.
Nothing. And the total amount you'd pay back over 30 years? About $1.4 million on an $82,000 home.
1.18 million of that was pure interest.
Pure interest. People literally could not buy homes. The housing market essentially froze. Sellers had to offer assumable mortgages where the buyer could take over the seller's existing lower rate loan just to make any transaction happen.
So Volcker causes 2 recessions, unemployment hits almost 11%, the housing market freezes, and he's considered one of the greatest Fed chairs in history?
Because it worked. Inflation went from 14.8% to 2.5% in 3 years. He cauterized the wound. It was brutal. It was painful. But he broke the back of inflation, and the entire economic boom of the 1980s and 1990s was built on the foundation he created.
Even his enemies respected it in the end.
When he spoke at the convention of the National Home Builders, the very people who hated him most, who had sent him the lumber, when he finished the speech, they gave him a standing ovation.
Wow. So bring this back to 2026, because we're not in a Volcker scenario, but the dynamics rhyme. What's actually keeping rates stuck right now?
A few things converging. First, the Fed paused rate cuts in January 2026. Inflation is still above their 2% target. The oil shock from the Iran conflict, which we covered in episode 2, is adding upward pressure. And then there's something people aren't talking about enough.
What's that?
Fed Chair Jerome Powell's term expires in May of this year. A new Fed chair will be named.
And that matters for mortgage rates?
Markets hate uncertainty around Fed leadership. Anytime there's a question about who's running the Fed and what their philosophy is, bond investors demand higher yields to compensate. Higher yields, higher mortgage rates. It's that direct.
So we have a new Fed chair coming, inflation still above target, an oil shock, and the bond market pricing all of that in at once.
And the result is, even the most optimistic forecasters are projecting mortgage rates stay in the 6% range through 2026 and into 2027. Nobody is forecasting a return to 4 or 5% mortgages in the foreseeable future.
And yet, 1 in 5 homebuyers is still waiting for 5% below before they buy.
Which means they could be waiting a very, very long time, possibly the rest of this decade. Okay, 3 wealth moves, because we always leave our listeners with something they can actually do.
Move 1. Stop waiting for 5%. It's not coming anytime soon. And the longer you wait, the more home prices may appreciate around you. There's actually a phrase that I love: date the rate, marry the house.
Buy at 6%, refinance when rates eventually drop. The rate you start with doesn't have to be the rate you keep forever.
Move 2. If you bought at 7% or higher in 2023, start running the refinance math right now. If you borrowed $400,000 at 7.25% and rates drop to 6%, your monthly payment drops by $331.
Set a rate alert with your lender. Don't chase it manually. Let the alert come to you.
Move 3, and this is Grant's big one. Bookmark the 10-year Treasury yield. Watch that number, not the Fed's announcements.
When the 10-year yield drops sustainably below 3.5%, mortgage rates will follow. Until then, 6% is your reality. That one number tells you more than any Fed press conference.
And move 3.5, if you have any adjustable rate debt right now, think carefully about locking into fixed rates while you can, because if a new Fed chair comes in with a more aggressive inflation-fighting philosophy, a modern Volcker, short-term rates could move faster than anyone expects.
The lesson Volcker taught us is that central banks, when they decide to get serious about inflation, can move further and faster than anyone anticipates. We're not in that scenario today, but the insurance against it is cheap right now.
Grant, close us out. One sentence.
Paul Volcker once said the job of the Fed is to take away the punch bowl just when the party is getting good. The party of ultra-low mortgage rates ran from 2020 to 2022. The punch bowl was taken away, and it doesn't come back just because you want it to.
6% is not a crisis. In the full sweep of history, which Grant will remind you stretches to 18%, 6% is actually pretty normal.
It just doesn't feel that way if you bought in 2021 at 3%. But that was the historical anomaly, not today.
That's Trek for Wealth. Thank you so much for listening. If you're navigating the housing market right now, share this episode with someone in the same boat. They need to hear this.
Links to all our sources are in the show notes. Do your own research, come to your own conclusions.
We'll see you next week. Keep tracking.
Take care, everyone.